As the markets closed for the weekend, NUBURU Inc., ticker BURU, settled at 33.86 cents. That's a tiny gain of just over 0.25%, but that flatline close tells absolutely none of the story. The real picture of this stock wasn't in its close, it was in the pure chaos of its trading day. The stock rocketed to 37.41 cents and plunged to 32.13 cents, a staggering intraday range of over 16%. More importantly, look at the volume. Over 101 million shares traded hands. For a microcap stock, this isn't just interest, it's a battlefield. This is what it looks like when narratives, hope, and extreme financial risk collide. The expectation you see plastered all over social media, on X, on Reddit forums, is that BURU is on the verge of something big. The narrative is that this is a company in the middle of a brilliant transformation, that insiders are loading up, and that a massive short position is about to get squeezed into oblivion. The reality, however, is that this company is in a desperate existential fight for survival, and the 100 million share volume isn't a sign of consensus, it's the signature of a war between a retail-driven narrative and a balance sheet that screams going concern. Let's establish the common ground, the story that's pulling in all this volume. The expectation is built on a flurry of recent press releases. Just this past Friday, the company announced it completed the first phase of its acquisition of Orbit, a software platform for crisis readiness and command and control. This, combined with the news from October 22nd of a strategic alliance with Maddox Defense for a drone joint venture, paints a picture. The market believes BURU is successfully pivoting from a niche hardware company into a diversified, high-growth defense and software player. This is the story. You add in the fact that the company just regained its NYSE compliance on October 16th, and the bull case writes itself. Retail traders see a stock that was beaten down to 12 cents, they see a company making aggressive moves into hot sectors like defense and drones, and they see a 52-week high near $1. The math in their head is simple. If this pivot works, the stock doesn't just recover, it multiplies. And then there's the gasoline on the fire, the short interest. Now let's challenge that expectation with the hard, cold reality of the data. That 101 million share volume day wasn't just bulls buying, it was a frantic exchange. Fintel data reports a staggering 26.84% of the float is sold short. That's over 20 million shares betting this company fails. Those shorts aren't just stubborn, they're looking at the company's financials. As of the last major filing, NUBURU had an accumulated deficit of over $150 million. Even more alarming, as of June 30, 2025, its cash on hand was just $111,090. Let me repeat that, $111,000. This is not a company making acquisitions from a position of strength. This is a company that has a substantial doubt about its ability to continue operations. Warning. That $12 million public offering they completed in September wasn't for growth, it was for survival. It was to get that cash balance up from fumes and to fund these new ventures. And every single one of those $12 million came from selling new shares, diluting the very retail investors who are now bidding the stock up. The frustration you see online, the accusations of short and distort campaigns and manipulation, stems from this disconnect. Traders are watching the company release what sounds like world-changing news only to see the stock struggle to hold gains. They feel cheated. They feel like the shorts are winning, but they may be ignoring the fundamental pressure that gives those shorts confidence. This is the crowd psychology driving the volatility. You have one group, the longs, who are emotionally invested in the turnaround story. They see the 100 million volume day as confirmation. They are scared, we are winning. They point to positive insider sentiment, noting that 8 different insiders have been buying. This is a powerful emotional anchor for them. The opposing camp, the institutional shorts, couldn't care less about a press release. They care about cash flow, and BURU has virtually none from its core operations. Its trailing revenue is almost zero. The shorts are betting that these acquisitions, like the Orbit deal, which itself is a complex related party transaction with NUBURU's own executive chairman, are a Hail Mary. They are betting the company cannot possibly generate revenue from these new ventures fast enough to offset its cash burn before it needs to dilute shareholders again, and again, and again, until there's nothing left. This creates the insane volatility we just saw. Every time the stock tries to break out on a news spike, shorts see an opportunity to add to their position at a better price. Every time the stock dips, the squeeze crowd sees a discount and piles in, creating massive volume surges that bounce the stock between its daily low and high like a pinball. Let's dig deeper into that recent trading activity. That 16% intraday range on Friday is where the story is. The stock gapped up at the open, likely on the new Orbit acquisition news. This is the expectation-driven buying. But it failed to hold those highs. It sold off, hard, all the way down to 32 cents before finding a floor. This isn't just panic selling. This is programmatic. This is what happens when short sellers defend a position and when day traders who bought the pre-market high have their stop losses triggered. The fact that it rallied back to close near its opening price on 100 million shares shows that neither side is giving up. The bulls successfully defended the 32-cent level, but the bears successfully defended the 37-cent level. This is a stalemate, but a very, very loud one. The average volume for this stock is massive, but Friday's action was exceptional. This level of volume, sustained over days, suggests a massive redistribution of shares. The old, long-term holders are likely long gone. This is now a stock almost entirely in the hands of short-term speculators, hedge funds, and a very vocal retail community. This is why it's so high risk. There is no fundamental floor to speak of, only psychological levels of support and resistance being carved out by this trading war. So, what does NUBURU actually do? This is the part of the story that often gets lost in the noise of squeeze chatter. Originally, NUBURU was a pure play on blue laser technology. Its core idea was that blue lasers are fundamentally better than traditional infrared lasers for processing certain materials, especially copper and other reflective metals. This has huge implications for industries like e-mobility and battery manufacturing. Welding copper hairpins for EV motors or welding the tabs on battery cells is notoriously difficult with infrared lasers because the copper reflects so much of the energy, causing spatter and poor quality welds. NUBURU's blue laser, in theory, is absorbed far more efficiently, allowing for spatter-free welding, higher speeds, and better quality. This was the original promise, the technology that was supposed to make it a key supplier for the entire EV and electronics industry. The problem? That promise never translated into revenue. The company has struggled profoundly with commercialization, its revenue has been negligible, and its losses have been catastrophic. This is the old story. The new story, the one causing all this excitement, is that the company is taking this core technology and bolting on new businesses, specifically in defense. The Maddox drone JV and the Orbit software acquisition are a deliberate, company-saving pivot. They are trying to tell the market, forget the last few years, we are now a defense and software company. The market and the short sellers are now in a violent disagreement over whether this pivot is a brilliant move or a desperate last act. Looking at its past performance, this is a stock that has inflicted immense pain. It came public via a SPAC, a path notorious for overpromising and underdelivering. It has seen that share price collapse, and it has to resort to dilutive offerings and, in the past, reverse stock splits just to stay listed. This history is exactly why the retail community is so frustrated and, paradoxically, so hopeful. They feel the stock has been unfairly punished, that the shorts have been piling on a company when it was down. This creates a powerful us versus them mentality. Every press release about a new defense contract or acquisition isn't just a business update, it's a weapon in their fight against the hedge funds. The disbelief among this community when the stock fails to rally on good news is palpable. They're screaming, how can the price go down after they announced a new drone venture? The answer, which is often ignored, is that the market is weighing that potential future revenue against the immediate, certain reality of dilution and a balance sheet on life support. So, where does this go? The future outlook is balanced on a knife's edge. Let's frame it using our expectation versus reality model. The bullish scenario, the one the retail crowd is banking on, is that the pivot works. The expectation is that the Orbit software and the Maddox drone JV start landing real paying contracts. The narrative is that the 100 million revenue target they threw out for the JV isn't just a dream, but a real forecast. If NUBURU can announce even a small, tangible contract from the Department of Defense, it would lend massive credibility to this new story. This is the primary catalyst everyone is watching for. A real paying contract would force shorts to reconsider their thesis. With a 27% short float, any real credibility could trigger a scramble to cover, leading to the very squeeze that is so hotly anticipated. In this scenario, the 100 million volume day was the low volume shakeout before the real move. The bearish scenario, the reality the shorts are betting on, is far more grim. The risk is that these acquisitions are nothing more than a new coat of paint on a crumbling building. The risk is that these new ventures burn through the $12 million raised in September with nothing to show for it. The biggest risk of all is further dilution. With only a few months of cash on hand, management will have to raise more. This is not a maybe, it's a certainty. The only question is how. Will it be another public offering that crushes the stock price? Will it be toxic convertible debt that hangs over the stock for years?
The shorts are betting that this dilution is inevitable and that the new ventures won't produce revenue in time to offset its cash burn before it needs to dilute shareholders again and again and again, until there's nothing left. The retail sentiment, now hopeful, could turn to despair with one more dilutive offering. This brings us to the central tension. The expectation is a high-tech squeeze play. The reality is a high-stakes bet on a corporate turnaround funded by shareholder dilution. The two sides are in a deadlock. I want you to weigh in on this. Comment below with what you think is the single biggest risk for NUBURU right now. Is it the cash burn or is it the 27% short float? As we head into the next trading week, the setup is incredibly clear. This is not a stock for fundamental investors. This is not a stock for the faint of heart. This is a pure narrative-driven war. The bulls are armed with press releases, insider buying, and a powerful squeeze story. The bears are armed with the company's own balance sheet and its going concern warning. Friday's 100 million share session proves that the battle has been joined. The expectation is a rocket ship. The reality is that this